You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, this is Jim Brogan. Sorry for the technical difficulty, but thank you for tuning in this week. This is 98.7 WOKI, and it's been a very, very chaotic week in the markets, week and a half really, since the tariffs. It's been this whipsaw effect, back and forth and back and forth. You know, of course, the recently announced tariffs really have led to these quick reactions from the stock market. Many investors have been watching their account balances shrink, feeling uncertainty about retirement savings. And some have been concerned about the future of our economy. Others have not been as concerned. Where should we be in all of this? What is the long-term threat to our economy? I have several things I want to talk about today. We have special guest Dr. Harold Black. Dr. Black is a professor emeritus at the University of Tennessee after retiring after 24 years of service, and he's a former James F. Smith Jr. professor of finance. He's known as one of the country's leading scholars on monetary systems. And I want to talk about 3 or 4 things today. We're going to talk about the impact on tariffs, the good and the bad, if there is any good. And then we're going to talk about the Federal Reserve. I want to talk with Dr. Black about Federal Reserve policy. And then I also want to talk with Dr. Black about the federal debt. So we're going to talk about more than just tariffs and current market conditions. We're really going to kind of dive into all of these things. And then at the end of the show, I want to cover 3 things that you can be doing right now. How should you be reacting to this? And what can you do to secure your financial plan? Dr. Black, it's so great to have you back with us. Good morning.
Good morning, Jim. How are you this morning?
I'm doing just great. Well, man, I tell you what an interesting week and a half. What is your opinion about what's been going on in the last week and a half and what's going on with tariffs?
Well, first off, let everyone know that I am not a fan of tariffs. Secondly, I want people to know that in my career is more than just academics, because a lot of people talk about academics in some sort of ivory tower. But I've spent a good deal of my career as a federal regulator of financial institutions, and in my private work, I've been a consultant and a member of the boards of directors of 2 of the largest financial companies in the country. So I have a pretty broad perspective of things and a pretty unique, in some ways, ways of looking at things. But generally speaking, I am not a fan of these tariffs, in particular how Trump has executed them. He has called them reciprocal, but they're anything but reciprocal. Generally speaking, reciprocal means that if you impose a tariff on me of a certain percent, I will impose one on you equal to that, and then we can negotiate whether or not we should leave them in place, raise them, or lower them. Trump's tariffs are not that. They're not reciprocal at all.
What is your view of how the market has responded? Has the market been too extreme in its reaction, or maybe not as extreme as you would think, knowing what we do now?
Well, actually, I think the market has been the checks and balances on Trump's actions rather than, let's say, the Congress. The Congress has given up its control on tariffs. The Constitution gives only the Congress the right to set and impose tariffs. And the Congress has said that the president can declare an emergency and impose tariffs. But in my opinion, any emergency declaration should be met with a 2/3 vote in each house of Congress, but that didn't happen. Here's what happened. The markets reacted very negatively to Trump's so-called Liberation Day. And so the stock market falls dramatically, wiping out over $10 trillion worth of value when it fell. Now, that in and of itself, I don't believe was enough to make Trump pivot as far as his tariffs were concerned. I think it was the sell-off in the Treasury bond market that caused that.
The 10-year Treasury really spiked up, right?
It did. The 10-year Treasury initially fell from 4.2 to 3.9, and then it jumped up to 4.5. Now, let me tell you, your listeners, why that's important. There is $9 trillion worth of U.S. government debt coming due mainly in June of this year. And for every basis point, that's 100 of a percentage, for every 1 basis point move in the 10-year Treasury, the debt cost moves by $10 billion. So if the Treasury bill rate fell 300 basis points, then that would be a $30 billion a year savings in interest costs to the government. But with it jumping up to 4.5%, that means a $30 billion increase in the cost of carrying the debt for the next 10 years. And I believe that the fall in the stock market plus the rise in the rates in the bond market caused Trump to, as some people say, blinked, but I say toned down his tariffs.
Yeah, I think that's overlooked a lot because what happened in the bond market, especially Tuesday night, maybe had a huge impact on Trump going into Wednesday and reversing his perspective. That's interesting about the treasuries because the way that investors react to things like this. Usually when investors sell off stocks in times of crisis, they pile into U.S. Treasuries. But as we mentioned, there's been a sell-off in Treasuries. So, is that raising questions of U.S. investment? Is it raising questions of how much investors feel confident in the U.S. government to pay its debts?
But I don't know if it means exactly that, Jim, but I think it does mean that America as the, quote, safe haven is questioned. In other words, I don't believe that there is any concern about America's ability to repay its debt. That's my personal opinion. But I do believe that investors who traditionally look upon the U.S. as a safe haven and, of course, the treasuries as the safest in that safe haven are questioning that because of this erratic movement in tariffs. If, for instance, Trump wants the Fed to lower interest rates in order to support whatever he is doing, but lowering interest rates, of course, means that there is the possibility of increased inflation. And increased inflation then, as you know, wipes away the real value of one's investment. And so if the market thinks that, then yes, there will be a movement away from U.S. bonds into other foreign instruments. One of the beneficiaries of all of this, one of the things that's happened is the value of the dollar's going down, the value of the euro's going up, and especially the value of the Swiss franc is going up.
Well, there's certainly a lot of dynamics going on. I do want to ask you this. There's been a lot out of Trump about trade deficits and the deficits we have in the U.S. Are trade deficits bad? How do you view that, Dr. Black?
actually trade deficits are not bad. The U.S. trade deficits have actually, in the main, I know a lot of people will disagree with this, but I've always said prove me wrong and I'll adopt your opinion. But in the main, our deficits have been good for America. Now, here is the reason why. Think about this. I've said I have a trade deficit with Kroger, Publix, Walmart, and Amazon, and yet I am not worse off because I have a trade deficit with them because of what I receive from them when I buy their merchandise. Well, what has happened with trade deficits, of course, is that the U.S., mainly because we are so big and so wealthy, we run trade deficits with most countries in the world. And we're talking about a goods deficit, by the way, and not a services deficit because we actually have a fairly significant trade surplus in services.
Well, you read my mind because I was going to actually ask you about that.
Oh, okay. But briefly, when we buy these foreign goods, what we do is we have to give them dollars. And what do they do with the dollars? The dollars have to eventually repatriate themselves back into the country. And so foreigners will use the money that we have used to buy their goods to come into the United States. They buy our stocks and bonds.
Yeah, they invest in the United States with that money, right?
That's exactly right. They actually support the U.S. enormous budget deficit because they buy the treasuries that are used to finance the U.S. deficit. They also use that money as a reserve currency and either hold them or pay each other in dollars, which will eventually come back to the United States. And so the mere fact that we are so large, the mere fact that we are so wealthy causes, in part, this money to then flow back into the United States, and it boosters the U.S. economy and U.S. markets.
That's very interesting and something that's not talked about much even in the financial media. We're visiting with Dr. Harold Black, and we're talking about the impact of everything going on with the tariffs. And as Dr. Black mentioned in my first question, he is much, much more than an academic, tremendous real-world experience. So he brings a perspective with his history and his experience that is very, very worthwhile to listen to. When we come back, I want to kind of pivot a little bit. We're going to talk a little bit more about the tariffs and the idea of what's Trump's end game here. Is this negotiation, is the U.S. better equipped economically to deal with this than other countries? And does that give him a strong hand in negotiation? But then I do want to get on to things like Federal Reserve policy. And then the one thing I really want to talk with Dr. Black about is our federal debt. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I'm Jim Brogan, and we're visiting with Dr. Harold Black, real fixture in the East Tennessee community, has been a really expert on monetary policy for 50 years, maybe more. And so we're visiting with getting his perspective on what's going on with tariffs. Before we leave the tariff thing, Dr. Black, one of the things that I've talked about all week, and especially on Monday and Tuesday, is, the tariff plan announced by Trump a week and a half ago. Nobody really thought that's what's going to be in place 90 days later. And we know Trump likes to negotiate. He's definitely a wild card. if we consider all that, the U.S. economy, we've been between 2.5% and a little over 3% economic GDP growth. Last year we were 2.8. We are economically, many would argue that we are in a stronger position economically than most other countries in the world. Our consumer spending continues to remain strong. What is your view on the negotiation tactic of tariffs? Do you really think this is where Trump wants to be 90 days from now? What's your perspective on all this?
Well, Jim, I really don't know about the negotiation part, and here's the reason why. There are some countries that do not have any tariffs at all. One is Singapore, and yet they have imposed upon them this 10% tariff, Trump's 10% global tariff. Israel reduced its tariffs to 0, which is what I thought Trump wanted, but yet it remains that they have a tariff imposed upon them of 17%. Now, why isn't that 0? And the reason it's not 0 is because Trump's tariffs include not just the country's tariff, but also 2 other factors. One is called currency manipulation, however they define that, and the other one is the trade deficit itself. And so let's take any country like Singapore. If Singapore wants its tariff to go to 0, then what it has to do is, after it matches dollar for dollar imports and exports with the United States, it's got to command its companies to not sell the U.S. anything else after that point in order to make the trade deficit with the U.S. 0. Now, I don't know about you, but that makes no sense to me.
I agree.
One thing I want to point out to your listeners who may endorse these tariffs, think about the price that it will impose upon consumers and consumers' wallets. Trump mentions the Canadian dairy tariff. Well, the Canadians pay twice what we do for dairy and eggs. Do you think the American public will look kindly upon those prices going up after they rebelled against the 24% increase in prices during the Biden years? People have to realize that tariffs are nothing more than a tax on consumers, because the exporter country doesn't pay the tariffs, but the importer does.
Right, and then it affects the entire supply chain with this type of thing. I mean, if these actually stay in place, then everybody's going to be people are going to reach out to their suppliers and try to get their suppliers to cut costs. Manufacturers are going to try to cut costs, but ultimately some is going to be passed on to the consumer. And we're already seeing some companies actually have an item on their bill of sale that covers the tariff impact, so that people don't think they're just increasing their prices. So we're already seeing some of that. Are you, in terms of the effect on the economy, Dr. Black, how worried are you? Talk to us about stagflation, and how worried are you about stagflation? First, explain what that is, and are you worried about that?
Well, stagflation is an inflationary recession. That is, that we suffer a recession, and during the recession, what we have, instead of falling prices, we have increasing prices. Well, let's put it this way, Jim. If these tariffs continue, there is a very, very strong possibility that a stagflation will occur in this country. Now, we have not seen this for a number of years, but there is this distinct possibility that it will occur again. And like I said, only if these tariffs continue. And of course, Trump is a wild card. One doesn't know what it will take for him to actually change his mind.
And there are checks and balances. The Wall Street applied pressure in this past week, as we know, which probably led to, or definitely had a big hand in Trump's pivot on Wednesday. Also, you mentioned, Congress has kind of over the last 20 years, one thing that I don't love, Dr. Black, is, and I don't want to get too political on here today, but Congress has ceded a lot of the power to the executive branch when you look at our checks and balances. But they can take that back. So we do still have checks and balances. And, I think Trump does not want to go down as the next Herbert Hoover, right? He doesn't want to be remembered that way, I don't think. What do you say?
Well, I certainly hope that you are correct, because, as I pointed out before, the impact of Herbert Hoover and his Smoot-Hawley Tariff Act of 1930 was that when that hit the consumer's wallet, the Republicans not only lost the presidential election, they lost 100 seats in the Congress. And so I have actually said that if Trump doesn't scale back these tariffs and they start in maybe a month or two to hit consumers' wallets, that the Republicans have revived the Democrat Party, which some people have given up for dead, and it's quite possible that that there will be no safe Republican seats come in the midterm election.
And that is where Washington would be imposing checks and balances on Trump, even from within the Republican Party, I think. So I just think it's so early, and I think there's so much that has to play out. I do want to ask one last question on this, and that is people's political lenses. From my experience, in the financial markets, with what I do, Dr. Black, is when I manage wealth and do investment planning and investment management, I try to be as agnostic as I possibly can in terms of how I look at politics and the effects on money. And I think we have to be that way. The reality is a lot of investors, they allow their political lens to shade how they view current conditions. And I've said it this week in interviews with Bob Yarbrough and Phil Williams and Haller and Hilton Hill, is that I think people that are very, very pro-Trump, Trump loyalists, maybe are a little bit, what's the word? They're a little bit too confident right now. And then people that are very, very anti-Trump, it's gloom and doom. And I think the answers probably lie somewhere in the middle, and I think we do have to be careful that we don't allow our political lens to affect us as investors where we make short-term investment decisions.
That is well said. I actually say the same thing. I am an agnostic when it comes to these sorts of things. I have said in the past, and I've written in the past, that a great deal of what Trump is doing on the domestic side needed to actually be done, although I would have done it differently. But what he's doing, at least as far as our trading partners is concerned, is something that I really do disagree with, because I really believe that the end result makes Americans worse off economically.
We're visiting with Dr. Harold Black. It's great to have his perspective. When we come back, I want to talk about the Federal Reserve, and I want to talk about our federal debt. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in. This is More Living with Jim Brogan, where it's all about living the best years of your life your way. We're with you every Saturday from 9 to 10 a.m. and again 3 to 4 p.m. right here on News Talk 98.7 WOKI. You can also catch us online. We podcast all of our shows on Apple Podcast and Spotify. You can also download our shows at our website or stream them live, stream them on your iPhone or whatever device you have. Go to broganfinancial.com and click on radio. We'll have a podcast. If you missed part of this show today, we'll have this podcast up by Tuesday afternoon. We're visiting with Dr. Harold Black and getting his perspective on what's going on economically. There's so much going on. We've really been focusing on tariffs and the economic impact and how we look at it as investors. Let's talk about Federal Reserve policy briefly here, Dr. Black, and then I want to talk about the federal debt. You know, you and I have talked over the years here in person and on this show that, you know, the Federal Reserve in many ways, you know, have led to problems. Their easy money policy that went on for so long, well into 20, you know, really they started curbing back quantitative easing maybe too late, kept interest rates artificially low, maybe led to a lot of the inflationary problems along with COVID, of course. What is your view on the Federal Reserve overall in terms of their effect? And I ask that because right now they're in a delicate position of how do we make sure that we don't go into recession, which would be typically they would lower interest rates if they're worried about that, but if they do that, they're concerned about inflation. So talk about the Federal Reserve role in all of this and what you see going forward.
Well, I believe that the Federal Reserve is subject to political pressures, even though it is a quasi-independent organization in which the governors have fixed terms and they cannot be fired, if you will, by the president, even though I'm surprised that this president hasn't tried to do that because he really doesn't particularly care for Federal Reserve policy. I do think that the Federal Reserve is susceptible to political pressures, and I believe that that is one of the reasons why it endorsed all of this increase in government spending, which, of course, led to the inflation during the Biden years. Its bailout policy following the crash in the real estate market and in COVID led to a dramatic increase in its balance sheet of well over $10 trillion worth of assets purchased. I believe that all of those actually prolonged our economic misery. I'm one of the people who have said that if the Fed had taken less action, we might have experienced a deeper recession, but it would have been one that was quicker rather than one that has been lingering on. I still think that even 2.8% growth is slow growth for this particular economy. And so I don't know what the solution might be as far as the Fed because I do like the structure of the Fed. I do like the independence of the Fed. But I do believe that the Fed has been responding to political pressures. Now, I don't believe that the Fed will lower interest rates because of Donald Trump, mainly because I don't think the Fed wants to look like it's doing this as a favor to Trump, that it will resist that.
I agree with you on that. Now, we know it's not supposed to have any political influence, but I think I agree with you completely that to me it'd be almost naive to think that there's not any influence there because there most certainly is. At the same point, forecasters, in terms of future rate drops, I think the consistency was maybe 2 rate decrease prior to all this was maybe 2 rate decreases in the last 6 months. Now many economists are saying 4, but I think that's probably due more to just the economic impact, right?
I think that's correct.
Let's talk about the federal debt, Dr. Black, and the deficit spending. The debt's up to almost $36 trillion. Some economists disagree on is the debt increasing, is that a good or a bad thing? Now, if we look to the debt to GDP, we're higher than we've ever been. We're actually a little right at about where we were coming out of World War II. And that's the best way to measure our debt relative to periods, throughout our U.S. history. What is your view of the debt? I know if my memory serves me correctly, you're not as opposed to federal debt Is there a time, though, where it gets to be too big of a rock or too big of an iceberg?
Tim, that is an empirical question. And the reason why that's an empirical question, by the way, I want everyone to know that I'm opposed to the debt as it is now. I am opposed to the size of the debt. And the reason the reason I'm opposed to the size of the debt, Jim, is because I am of the camp that believes that increases in debt come at a real true cost to the economy. That in order to finance the debt, we have higher interest rates than we would under normal circumstances, which means we have less private domestic investment. So I actually believe that the U.S. economy should be growing at well over 3% and would be on an annualized basis in real terms if we didn't have such a debt burden. Now, that's why I'm opposed to the debt being the size that it is, because the financing of that comes out of all of our pockets in terms of lower economic growth. Now, but given the size of the debt, that's, like I said, an empirical question. You know, Japan has been running deficits well over 160% of GDP for the last 20 years. But Japan has been growing very, very slowly, if at all, over that period of time. But it's still existing as a country. It still is producing as a country. It's still exporting and importing. But it's doing it at a very, very slow rate. And I believe that we're headed in that direction if we keep the debt where it is.
So let's talk about, there are different ways to reduce the debt. You know, raising taxes is not the only way. Of course, there's a lot of argument as to, if we look at the Laffer curve, does increasing taxes actually help government revenue because it stymies economic growth? But overall, in fiscal year 2024, 55% of federal spending, $3.8 trillion, went to Social Security, national defense, and payments to the states. And of course, Social Security and Medicare are two of the largest individual programs funded by the federal government. Now, economic growth, inflation to a degree can help bring the debt down since we consider debt to GDP. But talk about the different ways that you think we can get our arms around the debt. I know that's a loaded question and probably would need a dissertation from you, but if you could sum up 3 or 4 different ways that could work collaboratively to help bring that debt down.
One of the things I think we should do, and I would have hoped that Trump would have done this, is to tell his cabinet that what he wants will be budgets from them that are gradually getting smaller, not just in a growth sense, but in an absolute sense. Now, what I mean by that is that budgets can grow grow increasingly, but at a decreasing rate. Now, some people will call that a decrease in the budget. I don't. What I would have liked Trump to have done is to tell his secretary that what he wants are budgets that are lower in absolute numbers to present to the Congress and lower in absolute terms every single year. What I have always favored is a growth in the federal budget not greater than the growth in the previous year's GDP. Now, if you do that, then in, 15 years or so, you will be back to a balanced budget and even a budgetary surplus. Another thing to consider is this. Now, I'm not an expert on entitlements and Social Security, but I read that if we change how we index Social Security, that we can generate a surplus in Social Security in 15 to 20 years and slow its growth every year going forward. I think that's something that also should seriously be considered by the Trump people.
With the amount of money in our budget that goes to Medicare, Social Security, prescription drugs, and Medicare and prescription drugs is really the elephant in the room. Social Security, there are pretty reasonable ways to solve the Social Security issue. You mentioned one. Another is just simply raising full retirement age for younger folks. Can make a big impact. But ultimately, Social Security and Medicare and prescription drugs is such a huge part of the deficit. Can we ultimately? I had a Washington insider, Dr. Black, that was on my show the weekend after the election, and of course we knew Trump at that point had won. The Republicans looked like they were going to take the Senate and also the House, keep the House, even though by a narrow margin. And he said it just is difficult. While there are different ways to reduce the size of the debt, it's just going to be difficult to accomplish it without some fundamental changes to these programs. Do you have an opinion on that?
I actually agree to that, and you know me, I'm basically a market economist, laissez-faire government with a small g. And what I would actually like to see are private market solutions to these issues backstopped by the government. Now, once again, I'm not an expert on these matters, but it would seem to me that those would be solutions that would be more optimal than what we're doing now.
Absolutely. I agree with that. Let's shift just in these last few minutes here, Dr. Black, to consumer sentiment, investor behavior. Consumer sentiment has been, before this all started, was very low. Now, if we look at it historically, when consumer sentiment is very low, we usually follow that with periods of stock market growth. We also know when we look at volatile markets, some of the best days in the market to be invested have been immediately preceded by some of the worst days. And we saw that this week with what happened on Wednesday. So talk about investor behavior and how we have to be very, very careful about how we respond in the short term to market events.
Well, you're the expert on that, but I think what you're referring to is buying the dip. And that is that when markets fall, like they fell dramatically, the basic underlying fundamentals in corporations that give the corporations value at all, those basic fundamentals have not changed. And because those basic fundamentals have not changed, those firms that were strong before the dip will be strong after the dip. And so many investors will do that. They will, quote, buy the dip. And that is, they will buy the stocks of companies who have strong fundamentals but have suffered this market drop, which is an exogenous to their basic operation. And I believe that that's what has gone on. And you know as well as I do the old saying that most individuals who are in the market and who are not professionals buy at the wrong time and they sell at the wrong time. And a good deal of what we may have witnessed is the market being influenced by that more than anything else.
And that's really the selling is really, the selling was really a big thing that I was wanting to emphasize there too, because, sometimes when we have economic turmoil like this that affects the market, people tend to get very uncomfortable, and we started to approach a 20% downturn in the S&P 500. Of course, the NASDAQ did hit a 20% downturn, which is considered bear market territory, and that's when people get really uncomfortable. And so, I get asked about, inevitably, when we have market turmoil, some people out there want to sell. And market timing is so dangerous because you don't have to be right once, you have to be right twice. When do you get out and when do you get back in? And in my view, that's just very, very difficult to do. Any comments you'd like to add on to that?
No, you're absolutely right. As a matter of fact, UT asked me to come back after retirement and teach one course, and I'm doing that this semester. And I had some students who came to me and they said, I've got this small portfolio. What should I do? And I said, do nothing. And so I agree with you wholeheartedly.
Yeah, time in the market is the most critical thing rather than timing of the market. My last question, Dr. Black, I believe in the resilience of the U.S. economy, U.S. companies, the U.S. consumer. And so regardless of how this shakes out, even if there is a resetting of expectations, I continue to believe in that. Would you say the same thing in terms of a long-term perspective? Where are we 5 to 10 years from now?
100%. I am always in awe of the American market, the American consumer, our resilience. And I actually believe that at the end of all of this, we'll come out stronger. That's my firm belief, Jim.
That's a great word. Dr. Harold Black, thank you so much for taking time out of your busy schedule to be with us. It's been an honor to have you on again.
Thank you, sir. My pleasure.
Absolutely. That's Dr. Harold Black. We've been talking about impacts on the markets of, tariffs, Federal Reserve policy, the national debt. When we come back, I'll have 3 things that you can be doing, that you can do right now today to make sure that your financial plan is secure. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in. This is More Living right here on News Talk 98.7 WOKI. I'm Jim Brogan. Great conversation with Dr. Harold Black. It's always good to have him on. Always enjoying hearing his perspective. Quickly, I've got 3 things you can do to secure your financial plan or make sure your financial plan and your retirement plan is secure. Number 1, count to 3. We really do not want to make irrational short-term decisions. All market downturns can be painful. Now, we're not in bear market territory right now. We got close, and then, as I mentioned, the NASDAQ 100 did enter bear market territory, but in terms of the S&P 500, we haven't quite hit that threshold of minus 20%. But that's when people get very, very uncomfortable. And every bear market is different and unusual. Don't know that we'll hit that this time. But that's when investors become very, very uncomfortable. And we just have to be very careful that we don't try to time that. I have a chart in my office that goes back to the late 1800s of the U.S. stock market, and it is about a 45-degree angle on a line. And really the roughest period of volatility we saw in all that, of course, was in the 1930s in the Depression. But if you think about what we went through in the 20th and then here in the 21st century, we've been through 2 world wars. We've been through 2 pandemics in that period of time. We've had hyperinflation. We've had regional wars. We've had terrorist attacks on U.S. soil. You think about all the things we've been through, and that goes back to what Dr. Black and I just talked about, is the resilience of American companies, the American economy, and the American consumer. So count to 3. Don't overreact. Now, number 2, reassess your risk and diversification in your investment plan. There are ways to hedge risk, especially if you own volatility in your diversification. In other words, you have a small amount of your money that profits from big downturns in the market, and it's convexity. A small amount pays off in a big way. And then 3rd, build time horizon into your financial plan. Your money that's at risk in the stock market should not be considered short-term investment. And money you're going to need a year, 2 years, 3 years from now. If you're about to retire, money you're going to need in your income plan, that should not be invested in the stock market, because in the short term, the market's completely unpredictable. But in the long term, it provides the greatest opportunity to beat inflation. Today we've discussed economics, because greater Wealth provides for more living so you can live the best years of your life your way. Thank you for tuning in. This is News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.